Hello, it is week 33, the 15th of August. My name is James Kim, one of the sales traders recording live in Australia. A couple of the instruments we'll be exploring today. We're going to be looking at the US dollar index, followed by the euro, the cable, the Aussie against the US, and then the dollar yen. We'll also explore some levels over indices, including Nikkei Futures, the US 500 index CFD, as well as the Dow index CFD. We'll look at some specific levels over WTI crude futures, followed by additional commodities around copper, gold, and the last instrument we'll be exploring today will be the ETF over the Dow transports. Quite a boring week for the US dollar index as it failed to even touch its 200 daily moving average. The US dollar will need some strong catalyst to reclaim this mark, but for now is currently in a holding pattern until it awaits the FOMC minutes. We also note that the US dollar is currently caught in a channel as defined by these green trend lines, and we expect support upon a test of the lower trend line should the US dollar experience some aggressive selling. But the real test for this week will be to see a settlement above the 200 DMA. The euro, on the other hand, currently sits above its 200 daily moving average. We saw a huge juice on Friday, only to be met with selling as it need its August high. So we mark these levels here as resistance for the week. The 200 DMA is expected to be the support for the euro, and a close below here may signal further losses to come. The way euro traded over the past week does signal that it may want to push one more time, so we cannot discount a higher move should it clear last week's highs as well as August highs here. Rallies may find resistance upon the euro trading at the orange trend line. However, above here there will be some attractive selling opportunities upon a test of the lower trend line of the channel the euro broke on the day of the Brexit vote. So for now, until it has a clear break below the 200 DMA, the euro bears should exercise patience. The cable continued its losses over the past week, closed on Friday at around the lows seen in July. These levels here are expected to be temporarily hold the cable from further losses, and a break below here may see next support at the 127 handle. To summarize our analysis from last week's presentation, applying the rules of a pennant breakout, we measured the entire range of the pole here. The highs seen on the day of the Brexit vote down to the lows in June, and we apply that range to the top of the pennant, which gives us 38.2% extension at 127. The Aussie Bulls would have cheered and celebrated the clear of the neckline, which defined an inverse head and shoulder formation of the Aussie. The rejection of its highs and a close below the neckline, which is again marked by this blue trend line here, points to a false break for now. A further sell down was experienced on Friday over the Aussie as we head into the weekend on the back of notable pressure among industrial metals, and we will be examining the weakness over crude in the next couple of slides, which has translated into direct selling over our commodity currency. On further weakness, near-term pullbacks should find support upon the Aussie trading close to this red trend line, which connects the 2014 highs through to this year's highs. A failure here would be a continued bearish development and implies a deeper pullback, which could see the Aussie trade lower to test this orange trend line. Our gains over Aussie this week will largely be dictated and influenced by the price of metals and iron ore. And as we look ahead for the week, a settlement again below this blue trend line is a huge negative for the Aussie, and we can expect further weakness to come. Obviously, our close for the week above here would translate for the inverse head and shoulder breakout to be in play. The dollar yen's high in the past week failed to take out the previous week's high, and the weekly settlement close to 101 should not sit well for the dollar yen bulls. The dollar yen continues to hover just above the 50% retracement level between the 2011 lows to the 2015 highs, and the longer it continues to trade around here, the increased probability of a violation of the support level. A crack of this support would be a huge near-term negative and argues for a deeper correction. Focus would then be shifted to the 95 to 96 zone. Near-term rallies this week could find resistance at last week's highs. The Nikkei, on the other hand, outperforms amid the weak tone for the dollar yen, as the Nikkei enjoyed a nice rally over the past week. Notice the high on Friday happened to come in at the 200% extension of this June range here, applied to the July swing low, which was its first of all its July's high before a retracement lower. So we all know the levels the Nikkei must take out this week, which will then turn the focus to a retest of this trend line, which coincidentally is where the 200 DMA is currently hovering at. This trend line is significant given it had held up Nikkei since February's lows through to early June, and when the Nikkei broke this trend line, it has capped its move higher on two occasions, here and here. A further rally and a test upon this trend line and the 200 DMA this week also happens to coincide with some very noisy areas where it experienced some traffic. So these areas here could serve as levels to unwind any potential long positions, or even areas to consider building short positions with stops above the trend line and above the 200 DMA. US equities continue to print new highs over the past week, and the market this week will watch how the US 500 or the S&P 500 trades following its current narrowing price action. A break below the rising trend line would serve as a near-term negative. It could also be translated as a break of a rising wedge. And a failure to make new highs for the Dow would mean we have a double top formation. The ASX is currently in a consolidation mode after hitting new 2016 highs 2 weeks ago. Last week saw the ASX underperform global equities, as the largest sector in the ASX, which is our banking sector, held the index back from breaking higher. For now, we mark a pennant formation over the AUS 200, which is currently trading within, and in order to run higher, it will have to break through the higher trend line here. A break below the lower trend line anytime this week opens up next support at this red trend line, which defines a neckline of an inverse head and shoulder formation. Positive momentum continues over WTI crude, with crude selling at a 3-week high last week. Just when the market thought that crude was losing steam mid last week, crude was well bid above its 200 DMA and managed to punch through the 44 handle, or its 38.2% retracement level between this year's highs to the recent lows. Now if we have a look at the 4-hour chart over crude, and if we measure the following range, so we look at the first up range here and we apply to the first swing low, we have 100% repeat in price ending at 45.43, which also happens to coincide with the 50% retracement level of crude between this year's highs to the recent lows. So we expect heavy resistance at these levels up to these swing lows here. These levels may serve as attractive areas to build short positions with stops above 46.20. Last week we mentioned that we had a concerning view over copper in the near term, as it failed to stay above this orange trend line that I'm marking here on the chart, and more importantly as it broke below the lower trend line of the channel, which connected the many higher swing lows through June and July. Copper had one genuine attempt at rallying off its 200 DMA last week, only to be met with a rejection at exactly this orange trend line, which we have been marking for several weeks now. Friday's close on its knees and right on the 200 DMA confirms the road for copper this week, as we have a bearish momentum framework and there is little evidence of a reversal at this point. So a break below the 200 DMA here would shift the focus to a retest of this green trend line, which connects the January's lows to June's low. Interim support till then is 211.40, which is the 61.8% retracement between the June's lows to the recent highs. This level also happens to coincide with this swing low here. Below here, the market would eye 207.54, the 76.4% retracement. But by this stage, copper would have the momentum to test this green trend line. And a quick observation again over the monthly chart of copper, which we shared most recently. We have a clear fade in momentum as we outlined in last week's presentation. So unless there is some kind of significant pickup in momentum, copper looks to potentially retest this long-term uptrend again. A violation of this trend line opens up much larger and aggressive losses over copper. After breaking below the green trend line, which has held up gold on 3 distinct occasions, once here, second time here, third time here, gold traded 3 times back above this territory with only 1 settlement above here. However, the weekly settlement happened to come in below this trend line. We now have 2 lower swing highs, and our sales trader Edmund Liu from Singapore highlighted on Friday a buy stop opportunity over gold as it currently consolidates in a pennant formation. The buy stop is only triggered upon a break higher of the pennant's upper trend line. For further details and analysis over that trade setup, please visit tradingfloor.com and search for Edmund Liu's latest post. And the chart of the week goes to the ETF over the Dow Transport, ticker IYT. One cannot argue against an inverse head and shoulder development currently underway over this ETF. So all eyes will be on this orange trend line which defines that neckline. We will continue to monitor its development, and should we get a breakout, we will start to set levels to target to the top side. And should we witness a genuine breakout of this inverse head and shoulder formation, which points to a much larger rise over the Dow Transports, then for those that have studied the Dow theory will know what this means for the Dow Jones Industrial Average and in general for US equities. Thank you for joining us on this presentation. We hope to be presenting again next week. Wishing everyone a fruitful and a profitable trading week ahead.